testimony on the PPP?
You're now
No,
live.
I was not. You can fill me in. I had to go defend us before Probst.
At the risk of the commissioner is unique in his ability to explain things. I've always found him easy to hear, but he said that the year in which the money was granted and when people spent it, and then the loan was forgiven, it was the following year that they owed the taxes on what had been forgiven, which was now income, and the 2 years didn't match up. So it was
Okay.
Senator Brock probably could explain it better than I just tried.
I knew I had heard an explanation because I had the same
Yeah,
question that Senator Bray did,
And
which was if you can deduct the income anyway, you don't owe any taxes. So what's the problem?
well,
And that
but you
the
can't
problem
deduct it
is
in
it's-
the, yeah, but that takes place in 1 year and then it's the next year. So when you combine the 2 years, it's a different picture.
Okay, and you have to come up with the cash and you can't withhold the cash from the grant, so the cash has got to
Won't be
come up
forgiven.
from your funding. Okay,
But
I knew I'd heard an
So
explanation.
that-
Senator Pearson.
maybe Commissioner Bolio could come back and help me, because the 2 year thing, I get that's a wrinkle, but it's not everybody. So I'd like to, what my understanding of a deductible expense is that it removes your tax liability, right? I got $100 deductible expense. I pay $100 less. It shows up as though I earned $100 less income, right?
Are you explicitly asking me that? Yes, you would get to
Yes.
0 on that. Yes.
Yes. So this PPP loan that becomes a grant after you use it as an expense, which is a deductible expense, as Senator Bray says, has already come out of your income. It no longer appears as though you made that money. So therefore, you're not paying tax on it because it's been a deductible, it's been used for deductible expenses. It has to be used for deductible expenses in order to be forgiven and become a grant, not a loan. And so what we're really being asked to do is to make it a double gimme. I think that's I'd really like to understand. Maybe the answer is yes, but it's always come with the righteousness of how dare you, how could you? And I don't quite understand, because it is a double dip, it seems to me.
I think, Senator, there is one example where I can get to that it's purely a double benefit. And that is in a case where somebody receives the loan and uses it exclusively on expenses that they would not have. Froze for a second. Sorry, I froze up there for a second, so I stopped. Am I back?
Back.
Yes, you're back.
Sorry about that. I think the scenario would be if somebody got a loan and used it exclusively for expenses that they would not have otherwise incurred a single dollar of. Then that argument, I think, can hold some water, because you're correct. In the vacuum, you've got just this income and just these expenses that were fully offset by that income. But the moment you have any expenses, which would have otherwise been deductible anyway under normal tax law, that would have come out of your sales, right? And so maybe somebody could make the argument that you would have laid off every one of these employees that you paid their full payroll with the PPP loan. But I don't think that's the case for most businesses. Some businesses, it was also, you could also use it for certain fixed costs, right? Like rent or mortgage, that was eligible as well. You would have certainly paid that out of sales. So the moment businesses start having some expenses that they would have paid out of sales before anyway, and paid them with this PPP loan, but the PPP loan becomes taxable, they are slightly or less slightly worse off because of that treatment of the PPP loan. I do concede the point that I think if it was somebody who had expenses that they absolutely would not have otherwise incurred, you could argue that there's a double benefit. But I think it's much more complicated if you have any other expenses that would have already been deductible, that they would have already taken out of sales. And again, the moment you do that, you have real potential cash flow problems. And I don't want to harp on this point too much, but it is significant to me that the 2 tax year issue is significant to me because, and I wish Graham were here, but I don't see him. You know, as Graham was modeling out, sorry, Madam Chair.
No, this is kind of an off the cuff discussion, and we will have Graham in and have a more detailed discussion. We've got 2 more things to go through, and then we'll see if we can get Graham, and we will have this final discussion somewhere around 4 o'clock. Can you stay with us then?
I didn't mean that. The point that I was looking at Graham for is I think as he was modeling costs or projections for revenue on PPP, he had made a point that it's a significant number who have the deductions in 20 and income in 21. I don't know if it might even be the majority for certain draws. So I mean, I do think that that's going to be a significant factor, particularly for pass-throughs who are going to pass through the income and the liability without passing through the cash. And I, you know, again, I look at this all as this was already forecasted into the budget. So there's no additional cost for it. So yeah, anyway, I'm happy to wait until the more holistic discussion on this. The other point on sections 4 through 8 are much smaller impact. Happy to talk about.
Yes, that sounds like it'd be much easier to do. Why don't we talk about 4 through 8? We'll move through these and then we will get into what we're attaching to this bill.
Yeah, so sections 4 through 8 of miscellaneous tax, I think is a lot of words to do something with very little impact. And essentially it's just creating consistency and modernizing the language about what types of payments the department is allowed to accept. For reasons that I don't really know, and a lot of the sections are really old, 50 plus years old. There were different parts of Title 32 that referenced what payment types were acceptable for certain tax types. Some of them are so outdated that they didn't mention things like ACH debit payments, which we absolutely accept for all tax types. So these sections are purely a technical ask from the department, in my eyes, to make it consistent. So if there's one section that talks about the payment types acceptable by the department, and then modernizes it to meet up with actual practice, that it's not just, you know, cashier's check or certified check, it's ACH debit and other types that we have in the modern world. This is not an ask to try to take alternative currencies or cryptocurrencies or other wacky stuff, anything like that. It's really just a clerical and technical cleanup in my eyes.
Okay, any questions on that one? Okay. Then we have the Burlington Waterfront, and is Mr. Hassler with us, or we? Yep, I see him there. And I believe, okay, hello.
Yes, Richard Hassler, a longtime assistant city attorney with the city of Burlington. I've taken a new position. I'm actually with the Community and Economic Development Office now, so I appear before you not as a lawyer.
Okay. And what is this in relation to the audit for the TIF district that the
Yes, the state auditor's office submitted proposed amended language to 5404A at the end of last month, and we asked to be heard on that because it definitely has some impact on how we manage personnel and revenues going forward. I did submit a short time ago just some draft language that we think addresses the concern raised by Mr. Hoffer, which was the amount of time that given the city place Burlington extension that was passed by the legislature in 2016 that allowed for the possibility of the district extending its life by virtue of retaining increment for the three parcels of property that comprise the old mall property, that could extend the life of the district for an additional 10 years. But that happens only if we satisfy conditions which we have yet to satisfy. So what we were concerned about was that the legislature set forth the audit schedule for communities going forward back in 2013, and we have our downtown TIF district is scheduled for an audit later this year. We've anticipated all along that the waterfront TIF district was scheduled to close out in 2025 and would be subject to audit then. It's still subject to those same timelines, with the only departure from that being if we satisfy conditions moving the City Place Burlington project ahead, that there would be an extension of our ability to retain the increment from those three parcels through 2035. Yes.
Okay.
Madam Chair,
Yes.
could I just ask Mr. Hessler a question, because I didn't see the language he suggested. I
Can you put that language up? Do you have it?
I submitted it to Faith. I don't have the technology to post it myself.
Yeah, no, I was wondering if Faith could put it up so we
well,
could see.
let me maybe
I
we can
posted
do,
it. If you give me a moment, I'll.
Okay, it
put
is
up.
posted.
well, let me ask you, the reason I interrupt is because I actually think it's quite easy to satisfy the auditor and the city and just give him a glimpse or the right to audit before potentially another 15 years or whatever, and make sure, as the city, as I understand its concern, is to not have two audits that are overlapping. And surely we can do this, right? I mean, would it be fine if I've not heard you say no audit? I've heard you say it matters when, and seems like that should be good enough to get us to protect, staff time, and also get the auditor the glimpse that he's eager to have.
All right, well, here's what, that essentially that's what I'm proposing. The idea would be that we would be audited in 2025, except however, that could conceivably be our closeout audit if we don't get our extension. But
Okay.
and then the language that I propose to clean this up is, except however, if the Burlington Waterfront TIF district has its debt incurrence period extended pursuant to the provisions of the 2013 Act 80 as amended, for the three enumerated properties provided therein, an additional audit for the district shall be conducted when the period to retain education increment for the other properties within the Waterfront TIF district has concluded June 30th, 2025. So it would just stay on its schedule. If we got extended, we would have an additional audit to close it all out in 2035. If we didn't, we would we'll do our downtown in 2021. It'll carry over into 2022. Then we'll get our waterfront TIF audit in 2025. And then we would have, if God willing, City Place Burlington moves ahead, we would have a 10-year audit on what we accomplished with that. And that, I think, doesn't subject us to 3 audits in 5 years if the project doesn't go forward. It would cover what the auditor wants and not overly burden the city. These things do take a lot of man hours.
Now, if it went forth and there is no, you've got your main audit in this year, right? And then if the city place doesn't meet the criteria for an extension, you would have a closeout audit in 25. And then, but if it makes that extension, you've got 10 years before a closeout audit. And I'm just wondering what's the norm for audits of TIF districts? Is it every 10 years?
There are, since 2013, the new TIF districts that come online now get 3 audits over the 20-year life of the district.
Okay, so you're looking like every 6.5, 7 years. Senator Pearson.
I just want to make sure I'm understanding. Is the proposal that the city gets an audit in 2025?
No matter what.
Way.
Okay.
Either way.
And then maybe it's the closing audit, or maybe it's the audit before the extension gets very far along. Is that what I'm hearing?
Correct.
Okay, thank you.
Okay. I think we can come up with a little shorter.
Abby can maybe do that for us. It's my understanding that satisfies the auditor. Obviously, we'll want to verify that, but
I can actually say that I did speak with the auditor's office earlier today. They like the flexibility their language proposes. We don't, for the reasons I've outlined. But I think, I think that the one issue I take with giving the auditor that degree of flexibility is that the auditor, we report every year in pretty thorough fashion, and we also go through, every TIF district goes through its own internal audit every year. So it's all out there. And under TIF law, the TIF districts are responsible for covering the costs of the state audits. But if there were problems that the state auditor, all the information's out there, and he can audit us at any time. We understand that. I think what we're concerned about is that the 2013 language created certain expectations that the city's been moving forward on and budgeting around, and having been through this, I know how much time it takes for multiple city departments to gather together and get everything done to comply with the state audit. And to do 3 of them in 5 years is.
Okay, so could you, 3 and 5 years, you've got multiple TIF districts, so 3 and 5 years for any one is too much unless there's really a problem. You're going to do one now, pretty much. You've got one in 25 that's going to happen normally, whether you close out or it's on a regular schedule. What if we said the auditor could do one additional audit if he feels necessary, but not earlier then are we talking 2030? So not earlier than 5 years?
Well, I mean, the problem is by statute, he has to do one when the district closes. So
Yes.
if we get, I mean, that's why I'm concerned that we would have 3 and 5 years, because we've already got one in the downtown. And then,
Okay, but I think they're gonna say these are, you know, the city chose to have more than one TIF district.
I understand that. I
Okay.
understand that, but if we do one for the waterfront TIF district in the next couple of years,
Yeah.
and then we don't get our extension, then we're back for another one in 2025 by law. And that is where the burden comes in, that we
Well,
can,
when will you know if you don't get your extension, you're gonna do one in 2025, right?
if we don't, that would be, yes, that's.
Okay, so you're gonna do one on your main one, on one of your districts now, right? 2021 in this area.
Correct.
You're gonna do one in 2025. If you get your extension in 2025 for 10 years, the auditor wants permission to do an audit within that 10 years. If we say not before, in that 10 years, he can do one audit, but not earlier than 5 years into it. So that you,
I understand where you're coming from, but I don't think that's what he's asking for. I think he's asking for the permission to do one sooner than 2025. And then a closeout district whenever the district closes out, whether that was 2025 or 2035. And what we're saying is doing one to close out in 2025 and another one between 2021 and 2025 is where the burden is occurring.
okay, so you don't want to have to do one like in the next few years because you're doing one.
We're
But
already,
once we get past the 2025, if we said not before 2030, which is a 5-year gap, unless you've got another one coming on your other project.
well,
It sounds like we need to understand what the auditor's asking for. I think not to have to do one, 3 and 5 years is too much. What I'm trying to figure out is right now, you're due to have one in 25 for your waterfront district, right?
without the extension, that's when we would have to do it. Yes.
Okay. So nothing's changing there. I'm not sure if you get if he wants, yeah, I understood him to say if you got a 10-year extension, that he wanted to be able to do an audit somewhere in that 10 years. And I'm not sure why saying he can do one, but not sooner than, 2030. Is a problem unless you've got other audits floating around. I can see why doing one before 2025 would be an issue. But what am I missing?
I think that the auditor is going to want to respond to my testimony with trying to clarify what it is that he wants to accomplish.
Okay, well, we will try and get a hold of the auditor's office and see if they want to comment. Otherwise, the auditor will get what we give him.
All right.
I understood it to be sometime in if the program gets extended for 10 years. Yes, and Faith is trying to get him. I knew she would. If the program gets extended for 10 years, he wants us to authorize an audit somewhere in that 10 years so that you have to pay for it. And he doesn't. If he just decides to come in and do that, then it's on his bill.
I think the easiest way for me to describe it would be right now, we are only scheduled for one more audit in our waterfront TIF district.
That's the big hole district, right?
Correct. And if
Yes,
we
okay.
don't get an extension, that would be in 2025. If we do, it would be in 2035. And our proposal is, and he wants to be able to do 2 more audits regardless. He wants the
Okay,
ability to squeeze 1 more in that could be as soon as, he says he wouldn't do it at the same time as the one we're having this year, but he could do one in 2022 or 2023. And then if we don't get our extension, we're back 2 or 3 years later to do another one,
okay.
which to us seems burdensome as opposed to just doing the one in 2025. And then if we get, and conceding that if we get our extension, we'll still do the one in 2025. We just don't want to do.
I think what you may get, 10 years is a long time to go without an audit. I think what you may get is one in 2025 and one more between 25 and 35. I think that may be the best we can do, or no audit. Committee, any thoughts on this? Senator Pearson?
Well, just that we need to hear from someone at the auditor's office because it's all.
He's coming in. I'm not sure who he is, but
All right.
somebody's coming.
I can mute and you can,
As long as you don't rattle papers or have barking dogs or ringing telephones, you're welcome to stay on. We're used to all of the above. Okay, we've got Tanya entering the waiting room. Welcome. That was it. No, okay, you're muted, Tanya. I need you to.
There we go.
There we go. Okay. We're trying to settle the issue with scheduling audits for the Burlington Waterfront District. My understanding, and correct me, they've got one going on now for their other district. If the waterfront would, according to schedule, they would have a closeout audit in 2025. If they meet all the criteria and get an extension for 10 years, they won't close out until 2035. They don't want to have to do 3 audits in 5 years. They seem to think, and Mr. Hassler, you can correct me, that the auditor would like to do one on the waterfront before 25 if it's not closing out, and then another one further on. I'm thinking if you did one in 25, because that's scheduled, then if it closes out, it's done, and that's it. If you did another one in 2015, 14, 16, somewhere in there, what is the auditor's office asking for?
Hi, this is Tanya Morehouse with the State Auditor's Office. I'm having a little bit of feedback, like there's a lag on what I'm hearing versus what you're hearing. I'm not sure how to fix that because it's the first time I'm on here, but
I'm not either. Okay. What dates is the office asking for? How many additional audits and when?
Okay, so the dates that we are concerned about is the last audit that we did was in 2010. And not having another audit until 2025 would be a 15-year period with significant activity in terms of debt issuance and improvements. So it's actually not the post 2025 period that we're concerned with. It's the 2010 to 2025 period. So the change that Auditor Hoffer requested was to allow us to do an audit sooner than 2025.
Okay. How did that happen? I mean, the
The
TIF
2020,
is there. The TIF is supposed to be closed out in 2025. So how did the auditor's office not schedule an audit before this?
so I think at the time that Act 80 was passed in 2013, we had missed that there was a change to when the Burlington Waterfront TIF district would be audited. It happened in session law, not in Act 2013. So Act 80 in 2013 specified that the audit would occur at the closeout of the TIF, but we didn't realize that session law in 2011 changed the closeout date to 2025. So when Act 80 was passed in 2013, we actually thought the end of the TIF was 2020. And so that still meant a 10-year period, but that's not as long a period as 15 years. At this point, I believe there's 15.7 million authorized for debt issuance for the waterfront TIF district post 2010. So that would mean that in total, between the TIF operations up to 2010 and then all the way to 2025, there's about 25 million in debt issued. So we looked at the first 17 million through 2010, but now there's another 15 and change allowed.
Okay, but we got into this situation because the auditor's office missed a change and an extension, and you didn't do an audit before this. We now have a town with 2 or 3 TIF districts, more than one. They're going through an audit in 21, Mr. Hassler, or about now?
We
for
are,
the other district.
the downtown TIF district is due to commence an audit sometime this year.
Okay, so they've got one now. Doing an audit for a town is expensive, and it ties up a lot of staff. And so the question is, I feel comfortable nailing the town with a lot of cost and a lot of staff time because of a mistake that the state made. And so how do we find dates that work? I know Senator Pearson, you got a solution?
Well, a question that maybe gets us closer. Mr.
Good.
Hessler, when do we
The
know,
auditors arrived.
when do we know about the extension? Because that seems to be one of the things you're talking about here is
We
there's
presently have,
a deadline pretty soon for that, right?
I can say 2 things here. One is that the closeout for the waterfront TIF district has been set since 1997 as 20 years from the date of the last debt incurrence on the original TIF. So before any of the extensions, that's not been a moving target at all. It's always been, back before any of the changes to our district, we had June 30th, 2025 as the closeout date for our TIF district, going all the way back.
You're misunderstanding my question.
Yeah.
You said that either the 2025 audit becomes the closeout audit, or it'll be an
Correct.
audit on the way to 2035. When does that decision get made?
That decision, currently the date for us to establish that we have a completion guaranteed contract 2025 is June 30th.
Getting feedback somewhere.
I'm hoping it's not May. June 30th, 2022.
20,
So a year
22.
from now.
An audit.
yeah.
2025. When does that decision get made?
Mr. Auditor, could you stop the YouTube maybe? I think it's
Yeah,
coming.
we're getting something going on. Doug is muted, but we're getting some kind of feedback either over YouTube. All right. Well, he's gone.
So in a year, we'll know whether or not this is a 3-year issue or a 13-year issue.
Correct.
14 months.
Another way of looking at it is to drag us all back a year from now and say what's going on.
Yep.
We don't want to wait till 2035. We need to schedule another audit. Or you didn't hit your deadline. We're going to stick with the original language that the legislature provided in 2013, and you're going to do your audit in 2025.
Okay. Well, it seems if you're closing out in 2025, it seems excessive to schedule an audit in 2022. If you are, and I accept that it's been a long time without a state audit, but we are where we are, and I'm not seeing a way that would perhaps distract the city from its ability to do something about the big hole, because their staff is spending their time doing an additional audit. Does Senator Pearson?
Well, I'm wondering if Ms. Morehouse could help us. Is there a solution in your mind that handles this? Is there a way to do like an audit in a year from now, and then just a little tiny audit if they are closing in 25? Like, there has to be a way we can do this so that the public is protected and the city can manage this. Any ideas for us, Tanya?
Sure. Sorry, I'm still getting that feedback where everything's kind of on a lag and I'm hearing two things at once, but.
Have you got two
just
screens open?
Oh, maybe that's what it is.
If I tune on my computer and my iPad, it's really weird. So don't have us on more than one.
Madam Chair, can you hear me?
We can hear you. Yes,
Thank you.
welcome.
Sorry for the confusion. There is something that needs to be said. Burlington is not currently undergoing an audit. We have planned one for this year. But what we projected and asked you to approve is the authority to switch the audits. We would never do two at the same time or even in subsequent years. The point is that the major activity that has occurred in the one that hasn't been done in 10 years deserves to be reviewed. There's too much money at stake and too much activity. And waiting another 5 years for closeout, if that's when it is really not in the best interest of the ed fund or taxpayers generally. I'm not sure what Mr. Hessler, intended, but he didn't share his proposal with us in advance.
Right, well, we're just working our way through it. So what we weren't clear on is what you've asked for. What you've asked for is rather than doing an audit on the downtown district this year, you would do the audit on the waterfront district and switch them out. Is that
correct?
Okay. And then when would you do the downtown district?
There's no rush. That they haven't really borrowed or spent much on that project. That's the point. We need to focus on the one where the action is.
Okay. Well, that sounds like a more reasonable request. So rather than 2021 or shortly, Mr. Hessler, rather than do an audit on your downtown district, which I gather is pretty quiet,
Well,
they would do the audit on the waterfront district.
I'm gonna say that the last audit we did with the state auditor, we spent 1.5 years across multiple departments doing an enormous lift. And because of that experience, we have been organizing ourselves and planning, and we've been told repeatedly that we are the next municipality to be audited is the downtown TIF district, and it's in the queue, and it's provided by legislation that it's supposed to be audited at that time, which is when we close out our debt incurrence period. So we have been preparing our downtown TIF district, which has done some $5.5–6 million worth of projects since it was created in 2011, and it's scheduled, and then it incurred first debt in 2016, and it is supposed to be audited at the end of the debt incurrence period, which was March 31st of this year. So in reliance on that and trying to organize ourselves as a municipality while we still try to advance projects, we have been preparing our downtown TIF district for audit. Yes, we have done more work in our waterfront TIF district, and we have a long time schedule to try to make sure that we can effectively be prepared for an audit at the closeout of the district, which was negotiated and understood to be in 2025, so that we have marshaled our resources and we are preparing for 2 audits over the next 4 years at a particular schedule. And now on May the 6th of 2021, we are, after receiving something in which we were told that we wouldn't be,
Madam Chair, if I
we didn't want to be inconvenienced so that they would work.
Okay, so you've been spending it a year or so getting your records together, doing the prep work, so you would be prepared for an audit. We've now said, oops, we're not going to audit that. We're going to audit this, and we're going to give you 3 months to do the prep work if you're lucky. So
Actually, Madam Chair, the prep work, as he describes it, shouldn't be something you do just prior to the audit. Either you keep good records or you don't, and I assume they have. So it's not as if they have to, spend a year preparing for the audit. A couple of points. First of all, the one that was done in 2010 was the first, and it was a very big deal. We now have done 6 or more. We are prepared to do this much more quickly. Second, the timing that he refers to was not negotiated with us. It was negotiated with you guys. Second, if we don't do theirs on the waterfront until 2025, that means that audit, that TIF, and no other TIF in the state will only be audited twice, And it is the most expensive TIF in the state. And why should they be treated specially? We found out about this recently and alerted you as soon as we learned about it. Furthermore, preliminary investigation by Tanya's team has found that they may very well have spent some money on something that wasn't approved as part of that TIF. The point is, every job we've done on TIF since 2013 has uncovered problems. Some of them are de minimis, but all of them can be learned from, and subsequent towns and TIF districts can benefit from them. This is the biggest one in the state. It should not be allowed to go 15 years without an audit. That's the bottom line.
Right, but I think we heard from Ms. Morehouse that there was some statutory changes
Yes.
that
in
your office
2011.
missed.
Yeah, but not by us. We didn't negotiate.
Oh, no, but you missed that the statute had changed.
It was in session
just
law. We had
to-
no reason to think that something was happening. Normally.
Yeah,
when
sorry,
people-
just to clarify, it wasn't statute, it was session law that the
Right.
change occurred in. And this particular TIF, I think, has had probably in excess of 10 changes, like through session law
I know.
and in statute. So, and it happened in 2011, I believe, was the change, which was,
Senator Brock.
I would just like to reemphasize something that the auditor mentioned. And that is, and he implied, audits are not necessarily always convenient, but they're always necessary for the protection of the public. And the notion that you could have a project that could go this many years without being audited is of in itself, I think, a major concern. People who are being audited, organizations who are being audited should not need to take months or indeed years to prepare. That in itself is a red flag, at least to me. And the notion of 3 or 4 months or whatever for preparation of an audit of this type is, I think, not unusual, and I think I would strongly support doing it.
The auditor can audit any TIF district at any time. We all understand that. The question is, first of all, there's 4 TIF districts that were created prior to 2006, all of which Milton, Winooski, Burlington, and Newport only received 2 audits. So, I mean, that was just the way, I mean, I'm not, and the issue is that these are legislatively mandated to be paid for by the cities themselves. We all understand that when we report that if there's red flags, we can be audited at the auditor's expense at any time. And I mean, the question is, when you move through legislation and you create law, and municipalities budget and plan around that law.
But if we switch out the audits, it's not going to cost you any more because you're already slated or budgeting to pay for an audit. There may be some increase because one project may be bigger. So that's gone. The time frame, I think, we can say not for 6 months, but it is a lot of money. And having chaired this committee when we did the statute that standardized the TIF rules, it was because we had 5 and every one of them had different rules and different requirements, and it seemed to depend on who your legislator was, what you got. So we standardized them, and we've still got folks outside the standard. But
One more thing, Madam Chair, with regard to the cost, I'm not insensitive to that, but it's not as if the money for the audit is going to come out of the city's general fund budget. It's a related cost that comes from the TIF funds themselves.
so it comes out of the TIF money.
Right.
But they budgeted an audit. In a different TIF fund.
Right.
All right. Okay, committee, any other questions? I don't know if we've got a solution, but I think we've learned what we're gonna learn.
Appreciate your time.
Okay. So we've still got to figure this one out.
Madam Chair, I feel like I need a flow chart for this one too.
I'm gonna leave it to you to draw.
Maybe the auditor can get us a flow chart, or Mr. Hessler.
Okay, so we've got, this one is complex and it's gonna give us some issues. All right, that gets us on to miscellaneous taxes and Abby and possible votes. And we'll do this one, and then we've got the PPP. And Abby is here, good. I'm afraid Maria might still be across the hall. They were going through the entire bill. And there were some questions about our per diem. So I stuck around to explain our thinking. I think we're fine. All right. So committee, does anybody have any problem with anything that's in this bill as it came to us? Okay. I think
Are we changing bills, Madam Chair?
No, we are on miscellaneous tax. And yesterday we had the quick walkthrough. Today we took testimony.
Do we still have Rebecca? I did have one question for
Yeah,
tax.
Rebecca's here. Well, yep, there she is.
Oh, she is. Boy, you are dedicated. Thank you. And
Graham is also here, so we're good.
meals and rooms on the facilitators. This is very straightforward to my mind. We did it similarly a few years ago around the you're muted around the Amazon whatever.
Online travel companies.
Yes, right, exactly right. Expedia, yeah. But my question is, somewhere in the building, there's a provision that allows takeout and delivery of alcohol, right? And maybe Senator Sorokin, is that destined for the governor?
Senator, you're muted.
And you're muted, Senator.
Michael, you're muted.
My apologies. Yes, that bill is H313. It's in finance and it's on the schedule for tomorrow. It's a miscellaneous liquor bill.
Okay, I saw it just came over.
Right. And it does extend the carry out of alcoholic drinks for 2 years and does a bunch of other miscellaneous fee changes.
Okay, and I guess does it allow for delivery of mixed drinks?
I don't think we touched upon that one way or another. Senator Brock, do you remember?
Randy, you're muted.
You're muted.
You mean mixed drinks to be served outside? Is that what you're referring to?
No, I think they're more specific. They say kind of like a place like Grab and Go or the restaurant itself deliver mixed drinks to your house.
Well, I know we've allowed takeout drinks.
Yeah,
I think that's all we did in this bill. Just to
I'm just wondering if there's any interplay, and if there is, we should understand it. I can tell you in Burlington, there's an extra, right? There's sort of like the local options on drinks, and so I want to make sure that those are my two questions. Is there any interplay? And then in a region, in a town that has an extra tax, is that handled in this, or have we missed anything?
Sure. Well, to the interplay issue, no. If, should a bill be passed where alcoholic beverages are getting delivered as well, it would kind of work as grocery delivery does now, which is a little complicated, but not so much. Like the delivery charge is prorated based on the taxability of the items in your cart. So you might have some tax exempt food, some taxable paper towels, and the delivery charge is prorated to the taxability. So in a future world where there's a delivery charge that may include alcohol at one rate and a meal at another rate, the same proration would apply there. But yeah, I'm not aware of any bill proposing the delivery of alcohol, just like curbside stuff, as Senator Sorokin said. And then in general, yes, these operators would be collecting local option tax appropriately. And that's the same with online travel companies and our rental platforms. That's all baked into the law.
And we had a fairly confusing discussion when we did it for the Expedia around their charge and how that was taxed or not. In fact, it was because we came to understand that that was a way that they cheated out or attempted to avoid taxation. Anything like, some of the delivery companies do charge a fee just for the delivery. Is that a taxable fee?
Mm-hmm. Yeah, everything that ultimately gets passed on to the consumer will be taxed, all part of the tax bill. And that could be the delivery charge or a service charge. And actually, these platforms often just kind of like price up the menu items themselves, like, kind of make it look like the menu's more expensive than it is, and, pocket those as fees as well. So all of that would be part of the tax base.
Okay, thank you.
Sure.
So where are we? So I think we're okay with everything in the bill as it came to us. We have the add-ons, and I think we've already passed out S53, so I'm pretty sure we're okay with that. The yield bill is just the yield bill. It's setting the tax rate based on the budgets.
Madam Chair,
Yes.
I am more than happy to put the yield bill onto this bill, but I hope we will discuss the yield rate or whatever, because a lot has changed since the House passed it.
Okay, well then maybe we need to see if we can get Mark Peralt to come in and talk to us about that. Okay. So
Madam Chair, may I ask about, that's in H152, that had a few other sections that your committee has reviewed, and it wasn't clear to me whether you wanted just the yield and the non-homestead
okay,
rate.
no, I think
or
we
the
went
others.
over it yesterday, right?
A few days ago, yes.
Okay, yeah. So just refresh our memory. What were the other two?
The other two sections, one deals with the excess spending threshold calculation, and it excludes certain capital costs. You heard from Becky Wasserman on that section, and from Jim Desmarais on the small school grants sections.
That just extend the small school grants. We gave them to towns that merged as an incentive. We took them away from towns that wouldn't merge. We're now, since those towns have been forcibly merged, we're just evening the playing field and saying they can keep the small schools grant, right? Am I remembering that correctly? Okay. We have Graham here, so maybe if Faith can send Mark Peralt an email saying we want to talk the thing. Your cat should meet Senator Pearson's cat.
She's very curious.
See, why do I even bother mentioning that Faith might do this? She's always ahead of me. Graham, PPP. You guys had some discussion after I left for probes. And I gather part of the issue is you got the loan in 1 year, you paid the expenses, and that's last year's I've got one constituent still working out with the UI, because they told him he was, getting a form, and he hasn't, but he didn't realize his employer was direct depositing his salary because the employer had gotten a PPP grant or loan, and he was laid off. As far as he knew, he had been laid off, and then his salary started to come in, which he had already applied for UI, and that gave him some issues. But Graham, walk us through what is the actual cost to the state, to the businesses? And the concern seems to be not that it's tax exempt once, but that it's a double dip. And help us understand this.
Sure, I will give my best shot. There's a lot to sort of chew on here. Graham Campbell from the Joint Fiscal Office. I guess the place I would start is talking about how this affects the revenues for the state. And I guess the short of it is that allowing PPP loans to be tax-free and to allow for the deductions to be, or for PPP expenses to be deductible, if that's what the route that the legislature wanted to go with, it would not have an impact on the revenues of the state. And that's because the forecast included an assumption that the legislature would pick up this sort of tax-free treatment for PPP. So if the legislature in this miscellaneous tax bill or another bill decides to pick up the exact same federal treatment that was passed in HR 133 in December at the federal level for tax year 21, then it would not impact the revenues for the state in fiscal year 22, 23, 24, 25. If the legislature decided to make the loan when it's forgiven, taxable, then we estimate that would increase state revenues by $9.7 million in fiscal year 22, 1.2 million in fiscal year 23, and about $300,000 in fiscal year 24. Now, there's a key difference between making the loan itself taxable upon forgiveness or not allowing the deductions. Most of the discussion in the legislature has been around making the loan, when it becomes forgiven, a taxable event rather than disallowing the deduction. Those two things have sort of a different revenue impact. And that's because for the majority of those businesses in tax year 20, so January to December of 2020, when they received a PPP loan, they spent the money in 2020. And so those deductions were taken in tax year 20. Right now, people are filing for their 2020 taxes with the exception of perhaps some corporations. And so basically, most of the expenses of PPP have been spent for those tax year 2020 loans, if not all of them. For tax year 21 loans, loans taken since January, those are likely also probably already spent, although the program's still ongoing. So there's a chance those will continue happening later into 2021, perhaps even into 2022, those expenses. The forgiveness of the loan is sort of a different timing mechanism. So if someone received a loan in tax year 20, in between calendar year 20, January to December, they might have used that money for the expenses, but then they have to go back and apply for forgiveness of that loan. And so it's likely that many businesses used the money in 2020 and then applied for forgiveness in 2021, and therefore the loan will become forgiven in 2020. I think that's the sort of story that you're hearing from maybe perhaps some of your constituents, that I've spent the money, but now I'm getting my loan forgiven in 21, and then all of a sudden you have this sort of mismatch. And I think that's what Commissioner Bolio was talking about earlier, that some of the loans will have been taken out in 2020, but then forgiven in 2021. We estimate in our modeling that about half the loans taken out in 2020 were forgiven or going to be forgiven in 2021. And then for the loans that are taken out in 2021, a vast majority of them, about 85%, will be forgiven in 2021. And so if the legislature decides to make this make the forgiven loan a taxable event, then it's likely that there will be about half of the total loan value of tax year 2020 loans will be taxable for those businesses in tax year 21. And then for anyone who took a loan in tax year 21, almost all of them will have that be a taxable event in 2021.
And I think, we heard, the testimony was from Mr. Lozon that the bigger businesses that have accounting departments were the ones, and he had numbers that came in early, that the bulk of the smaller businesses came in this year or in 21 because they were shell shocked last year. I think the other testimony we heard is, well, and the other thing I think we need to remember is for many of these businesses, there's very little, if any, income coming in last year. Many of them were shut down. So the idea was you kept people employed, but not necessarily working. That they were just receiving income, you were keeping them there, they were able to pay their heat, lights, whatever they needed to keep the business alive. But now if we make it taxable, they will have to come up with the cash to pay the taxes. And that's cash they won't have to reinvigorate their businesses or, depending on the amount, keep them alive. So there's also the income or lack thereof in the process. And I guess I'll say we've spent a lot of time on this, but it's the revenue forecasts that the budgets are being set on has assumed that these loans or grants are forgiven, trying to differentiate between good businesses and bad businesses and who we want to get the grants and who we don't think should get them is, I think, almost an impossible task. I'm just not sure it's worth the effort to try and parse this out. It's to make a difference. So Senator Hardy.
Thanks, Madam Chair. I just have a question for, I guess, Graham. When do the PP loan, when does that program expire? You said it's still going. I've seen ads for it. More people are trying to get into the game. Is it through 2021 or does it have an end date?
That's a good question. I don't know the answer to that question. I know right now the PPP program, I shouldn't say that's redundant. PPP is ongoing and there's about $70-ish billion left in the fund available. And it's been the activity has slowed down quite a bit in PPP. So it's still ongoing. I don't know when they close that fund. I can look into that. I think what I would just tag along on top of that for what Senator Cummings was saying was that we estimate that there are around $1.5 billion worth of PPP loans that were issued in Vermont. But we estimate that somewhere between 300 and 500 million would become taxable if the legislature made this taxable. It's not a simple, straightforward equation. It's just a business taking and looking about what their PPP loan was, and then just multiplying that by their tax rate. Because there's going to be a lot of businesses that first you need to consider whether the loan itself is going to be forgiven at all. We think that most of them will be. The second question is, in any given year, about 80% of corporate tax returns don't report any profit. And then amongst pass-throughs, it's about 30 to 40%. And so that's in a normal year. In a pandemic year, you might have a significant number of, that number might be much higher. And that's what we're trying to build into our forecast. And then the third question is, to what extent are some businesses, using the fungibility of money to sort of transfer, payroll expenses into another deductible expense, therefore keeping their net income down. And so I would just sort of say that it's not a simple, straightforward equation for most business. For some businesses, it will be if they are going to show a profit at the bottom line of their tax form. If the legislature made this a taxable event, then their tax impact would be their tax rate times the size of the PPP loan. But for a huge number of businesses, our estimate is that it won't necessarily change because they're reporting such a loss in 2020 and even in 2021 that they won't necessarily be paying tax on it. So that's one more detail I wanted to sort of follow up with Senator Cummings.
Okay. It sounds like Senator Sorokin might have an answer to the question I asked.
I know he's got an answer,
And
but
then I have a
I've
couple
got him
more
next.
little questions, but
Okay, why don't you finish and then we'll get to Senator Sorokin.
okay, thank you. So just to reiterate what you just said, Graham. So if a business has a loan and they're not profitable, even with that loan, even if it's forgiven, they're not necessarily going to pay taxes anyway because they didn't make a profit and therefore don't have taxable income.
If their net income, like let's say a business reported at the bottom of their tax line negative $100,000.
Yep.
If their PPP loan was $50,000, say, you're making that taxable is going to add to their net income, but they're still going to have a negative number on the bottom line.
And then if a business takes out gets a PPP loan and gets it, they have to follow the rules of the program and use the money for the things that are allowable under federal law for it to be considered, for it to be forgiven, first of all, and then two, to be non-taxable even at the federal level, correct? So like they don't use it for the right things, like this guy who bought an alpaca farm. Presumably he's not going to get to keep that money and not alone. Okay. So there are provisions about how to use the money that have to be followed first before any tax law would be on top of that, correct?
That's correct.
I see the commissioner nodding as well. Okay. I mean, since I have the floor, I'll just say, I think we should just, given that it's already baked into our revenue estimates and we've heard from so many people, I've really appreciated this extra time to understand it more. I think that's been really helpful. I would like to know when the loans end to see if we're going to have to deal with this again next year. But I think we should just move ahead with, at least my opinion is that we should move ahead and make them tax exempt and not tax them, whatever the correct term is. But so thanks.
Senator Sorokin. I hope you're wearing sunblock, Senator.
I'm in the shade right now, madam. It's cold.
It's cool out there.
Yeah, it's cool. So I think under ARPA, the PPP program was extended to May 27th. So that's, I think, is the end date.
This year?
I generally agree that there's a bunch of unfairness in treating this one way in 2020 and one way in 2021. I do think we should be doing the appropriate amount of due diligence on it, which we're trying to do here. And one of the questions I had, I think maybe Graham answered it already, is when Tom Lozan came in, we asked him questions and he sort of estimated the revenue loss to the state could be as high as $35 million. Either way, and you gave a lot of reasons that maybe he didn't consider in the projections. But either way, it's a lot of money. You know, the two issues that concern me, but maybe probably not enough, is it's important that we don't, especially with these large numbers, just piggyback on whatever the feds tell us to do. And you know, it may be appropriate here, but this is a big enough number where it needs due diligence. And I wanted to ask a question of both Graham and the commissioner. My understanding is 14 states have gone the other direction. Do you have any insight from your peers in other states which drives that decision? Is it just the amount of lost state revenue that's making them consider that? And one last point before I shut up is I probably agree with the chair that it's it may be an unnecessary or an unworthy exercise to try to distinguish one business from the other. But my understanding is, seems totally appropriate if people took the PPP money and put it towards keeping people employed and paid them where they otherwise had no business and were going to lay them off. But my understanding is also is, and I know some personally some businesses that had full employment and would have a payroll anyhow, and their revenues were kept up, and they took the PP money and it basically paid for their entire payroll that they would have had to pay for anyhow and hadn't lost any revenue in the process, because some businesses did very well during the pandemic. So that's sort of the yin and the yang. There's a lot of balances here. But I would like to know a little bit more about if this is so straightforward, why do 14 other states go the other way? And I assume a lot of states don't even have income taxes, or some states don't, where it's not a much of a question. So 14 states is a fairly big number. So I'd just like to get some idea on what the thinking was on that.
Sure, Senator. So I think,
Graham?
yeah, there's the Tax Foundation sort of think tank in Washington's been tracking which states are taxing PPP or, you know, not allowing for the deductions to be for businesses. And as of my research, there are about, looking at the map right now, it looks like about 7-8 states that currently do tax PPP loans. They don't, but what I would say is that I'm only aware of 1, possibly 2 states that have taken definitive action to make this a taxable event in some way, shape, or form. So Virginia is the first one. Virginia is allowing for the tax-free nature of the loan upon forgiveness, but they are not allowing any more deductions past $100,000. So you get the first $100,000 of PPP expenses allowed, and anything over that is not deductible. California is another one. They just passed a law. So they, before about 2 weeks ago, had passed a law saying the deductions were not allowed. But they've since come back and passed a law to pick up the full federal treatment, with the exception of some businesses. So publicly traded companies, for example, are not allowed to receive the full deduction. So those are the 2 states that I know that have actively passed legislation. There are a handful that, if you, I can send the link to the committee, like Texas, Nevada, Florida, North Carolina. Those states are technically still taxing paycheck protection loans, but in my research into those states, they either a chamber in the legislature has passed it, or the governors of those states has signaled that they want that legislation to come through, and they expect to sign it. A good example of that is New Hampshire. New Hampshire currently technically is taxing PPP loans, but the legislature there is moving quickly to to make it a non-taxable event on both sides, deduction and the forgiveness. And the governor there has signaled that he would like that bill to come through. So I think I wouldn't count on New Hampshire being a taxing state very much longer. So I guess to follow this or wrap this up is I'm only aware of 2 states right now that have, made specific, policy choices and put it into law to tax PPP loans.
Okay, but one has allowed smaller businesses,
Yes.
which I think are about 80% of ours, the 100,000 to go tax exempt. In Texas and California are worlds unto themselves. So they're just so big.
The other thing to keep in mind there is some of the states that are taxing it are doing it through a gross receipts tax and not a corporate income tax, right? And so that's one of the differentiators as well.
Okay.
So I think, Senator, to your point, the island's getting smaller and smaller of states that are not doing this. I think you had asked why had any state considered the alternative. I think for some, particularly some of the larger states, it was a question of budget, right? As I was talking to some of the other revenue commissioners around the country, they might be talking about $500 million in their budget. But I think one of the other advantages we had, again, was that our forecast included or assumed conformity on this, so that it didn't create that kind of budget headache. But there have been a lot of states over the last few weeks that have passed laws that got into the camp of both tax-free and deductible. And I don't know to the degree that the U.S. Treasury had released guidance within the last couple of weeks that basically said conformity with federal tax code is an allowable use of ARPA funds, because there had been that question about can states use those funds to offset tax cuts, and the U.S. Treasury said any conformity with the federal tax code that reduces a state revenue is not considered a disallowable tax cut. I'm not advocating for that for Vermont. We don't need to do that, but that might also be why many of these states who had budget issues are no longer concerned.
Okay. I've got Senator Pearson. Senator Brock, is your hand up, or are you just looking meditative? And then Senator Sirotkin. So I got Pearson and Sirotkin.
Sirotkin, did you have a follow-up? Because you seem
I did, but I was on mute. Well, I lost my turn.
No, that's okay. I'll give it back to you.
Okay, it was just a follow-up to Graham. I think I understand what's going on here in terms of the accounting and stuff, but I was a little confused by your differentiation between a deductible, non-taxable income versus a deductible expense. And I thought you implied that if we chose one over the other, that might affect the revenue of the state.
You're right. It would. It has different impacts. It doesn't. Again, I would state that it's baked into the forecast, so it doesn't affect the revenue of the state. But if the legislature decided that we wanted to make the PPP loan when it was forgiven a taxable event. So say when your loan is forgiven, that becomes taxable income. That has a different revenue impact than saying we are not going to allow the deduction of PPP expenses. And the main reason for that is timing. We believe that for loans taken out in 2020, all of the expenses were made in 2020. In fact, I think that was a requirement of the program. They had to be made relatively soon after you received the loan. And so essentially the revenue, if the legislature decided to make the deductions not allowed for tax year 21, 22, 23, the timing of that potential revenue impact, that potential revenue increase would be different than saying when the loan is forgiven, because people apply for the loan forgiveness after they've made the expenses. And so what I guess the difference between the two would be that if you made the loan, the forgiven loan taxable, then the revenue impact would come likely a little bit later down the line than if you disallowed the deduction.
And what do we do? What are we talking about here?
You could do either. And most of the discussion that has been in the legislature has been to make the loan when it's forgiven a taxable event, rather than disallowing the deductions.
A non-taxable event. Did you say taxable or non-taxable?
You can either make the loan taxable as income, or you can disallow the deductions.
Oh, that's if we want to collect the revenue. I was assuming if we didn't want, we would make either the loan forgiveness non-taxable or allow for the deduction.
Right.
Correct?
Yeah, I think that makes sense. I think what I would say is that if you decided to make, if you said we wanted to disallow the deduction, I haven't done a revenue estimate for that, but I could tell you that the amount of revenue raised would be significantly smaller than making the loan taxable. And that's because we assume that many of the tax year 2020 loans that were taken haven't been forgiven yet, or they're going to be forgiven in 21. Whereas we think that those loans in 2020, almost all of them have been spent for expenses, and they've been subsequently deducted on people's tax year 20 returns already.
So I think I've probably lost you a little bit. I don't know if other people are following you, but the only thought that is generated by what you just said, when we talk about businesses, for instance, that took this money and paid for payroll and kept people on when they didn't need them because the business was shut down or business was down, I'm very sympathetic to that group of businesses. And even though I said before, I agree with the chair that it's probably very hard to parse that group of businesses as ones that were running full bore and applied for PPP loans and just replaced their own payroll dollars with PPP dollars. Does either of these solutions, if we go in this direction, does it favor one type of business versus the other that I just described?
I would, under my opinion, no. It's very difficult to parse out which, unless you were
I'm not suggesting we parse out. I'm just suggesting we have a choice here of possibly making loan forgiveness non-taxable, or allowing for payments that were made with the loan to be deductible. And if those are our two choices to get at what most people want us to do, I'm just wondering, and I can't analyze it, but I'm asking you, do either of those choices make a difference in weeding out the businesses that help keep people employed versus businesses that basically took this money and, as we've read, a lot of them made a great deal of more profit on?
I would say that making the forgiven loan taxable would more likely hit those businesses that took a PPP loan but didn't, quote unquote, actually need it. And that's because if you don't allow the deductions, most of those businesses that took it in 2020 have already spent it, and it's already affecting their tax return. They've already deducted the expenses. And so for those businesses that took a loan in 2020 but haven't yet gotten it forgiven, either because they just haven't filled out the forms, or if there are businesses that didn't actually need the PPP money, you'd be able to sort of capture them in 2021 if you made the loan taxable. So I would say that if your concern or your goal is to sort of collect tax from those businesses that didn't actually, quote unquote, need it, then making the loan, the forgiven loan, taxable in 2020 would be more likely to capture the group. I would say, though, that it's sort of a blunt force method of doing it. But if those are your two choices, then the taxing forgiven loans would more likely.
I think we're moving in the direction of choosing one of those choices. I'm just trying to figure out which is the better.
No, I mean, either one of those. We're working on the assumption that there's a significant number of Vermont businesses who didn't do what they were supposed to. I'm not sure that's true. That took a loan that they didn't need. And the enforcement of that is really the federal requirements.
I'm not suggesting we enforce it. I'm trying to get to the same conclusion you are, but I'm just trying to find the better, one of the two ways. You got to do one or the other.
No, no, you don't. You do nothing. It's tax exempt.
You have to link up.
Right.
Yes.
But
Yeah, you have to link up with last year's, or just write that they will be taxed, I don't think, no, that we need to do it. Yeah, we just write in that it will be the same as federal law for this year. We did it with something else. I forget what else we did it with.
Can I clarify one element, Madam Chair?
Yes.
It's deductible under current Vermont law because H315 linked up to H133, which was the December law for tax years 20 and moving forward. So it's deductible in Vermont. What H315 had said, so current language says that it's taxable for tax year 21. So that's really, I suppose you could swap those. From my chair, having it not deductible is even worse than having it taxable, because it has a similar fiscal impact to those businesses, but administration is much worse. Obviously, for my chair, the governor has made his perspective very clear that I'd love to just have it not taxable, but I would really, it would be even more challenging, I think, to say the expenses are not deductible.
Okay, Senator Pearson.
Thank you, Madam Chair. I see Abby's come to life. So did you want to make sure?
I just got a note that said that Abby can stay late tonight, but not tomorrow. So guess who's staying late tonight?
Well,
we're gonna have to finish the bulk of this tonight.
So I just want to make sure we're talking about was it $9 million or $13 million impact on the forgiveness question?
So yeah, again, it's baked into the forecast. So if you make it a tax-free both,
I understand that. I understand.
Yeah.
Just what's the number?
If you make the loan taxable, we estimate that it'll raise state revenues by $9.7 million.
9.7.
Yeah.
Commissioner, I think I just heard you say that Congress clarified that us doing that would allow us to stick 9.7 million of ARPA into the general fund because we're complying and it has a cost. Do I have that right?
Yeah, I think so. Basically conforming any revenue impact for a state by conforming to federal law is an allowable use of ARPA funds. So I might ask Abby to make sure that is what her understanding of the Treasury guidance was as well, but that's my read.
Well, before we turn to Abby, I'll tell you why I'm interested in that point, because as we've been talking about this discussion, like everybody, I've concluded that we should probably go there. But there's also other very significant, possibly more costly decisions that are inexorably related, not the least of which is EITC, Earned Income Tax Credit, which is not in the forecast, correct, Graham?
That's not in the forecast. Steve Klein testified yesterday they've sort of saved money on the bottom line of the budget for that type of stuff. So
but it's going to be costly. It's a bigger cost than this. It happens to be one that for me personally is a bigger priority, but they just come together. I don't want to decide tonight on one and decide tomorrow on another. I think they need to be decided basically as a package. And because all too often, we get more generous with the business community sometimes than with families. And so this ability to use ARPA money to repair any hit to the general fund is pretty important as we try to sort it out, not the least of which is to try to describe it to the rest of our colleagues. So A, I'd like to make these decisions as a package, and B, I'd like to really be clear about the permissive, whether or not we can use ARPA money to the extent this is creating a hit in the general fund.
Okay. So it's my intent to resolve all these issues tonight and to vote this out because it is going to go to conference. And come in tomorrow just for some quick mop up. And this is the big one. And we've talked about it. I believe it was a $7 to $8 million hit for the other two. Is that right, Graham?
Yes, it's about 6.2 for EITC and 1.5 for the child dependent care credit.
That was that those are things we like spending money on. Senator Hardy.
Sorry, I didn't mean to interrupt, Madam Chair. I just wondered if Graham, I seem to recall you had given us a table or chart or fiscal note on the combination of these three items at some point. Is that on our?
I presented to the committee, I think last week. I can send what I presented to Faith, and she can send it around again if that would be easier, quicker.
Okay, I can dig for it, but if you can do that too, we'll see. I'd like to see it all together. Thank you.
I think one of the differences is that the PPP loans was not baked into the revenue forecast. But the EITC and dependent credits were not. They have put money aside, and I think it might be ARPA money to cover it. But when we asked Steve Klein, he said there was money left on the bottom line because they were pretty sure the legislature would pass the dependent care and the EITC changes. So those are the two that they'll have an ongoing impact. There's a tail that comes out of PPP. The bulk will be in 22, I think. And then it trails off because the loan program's going away. But the other ones are ongoing forever.
No, the earned income tax credit and the child dependent care are for tax year 21 only. There has been talk in the Biden administration.
Only for this year? All right.
But there has been talk to make these permanent. So I know that Ways and Means has sort of talked about thinking about these permanent things. Technically, according to the law that is passed, it's only for 1 year. So
Okay, then that's the federal law. All right. So they're only for 1 year, and the money is there in the budget. So these are all 1 year hits.
The two tax credits are, yes.
Yeah. With some tails floating around. Okay, Senator Sirotkin.
Just be clear, are you saying that appropriations has made it clear that they've set aside money in their budget calculations for these two things? I hate to bring up a broken record, but they apparently stripped out the downtown tax credits, but somehow they made an allowance for something that the House was passing?
No, the House did not pass this. This will definitely get us into conference.
Oh, well,
But
whether they passed it or not.
when asked, I said I thought this committee was favorably disposed to at least EITC. And that was just my impression from the original conference. Steve Klein's testimony yesterday, the day before, was that there was $8 million on the bottom line to cover those two credits. If we don't pass them, then we got $8 million to do other things with. But the thought was that this will help working families, and that there was a pretty good likelihood that we'd pass them. Committee, I'm about ready to take a straw poll because we've got to move this forward. So, Senator Hardy.
So, did we get an answer from Abby or Graham or the commissioner about the use of ARPA funds? And Did you have that answer, Abby?
Yes, I'd be happy to chime in. I confirm the commissioner's understanding for what I'm reading, both on the Treasury's website and looking at ARPA itself, which restricts the use of the state and local funds. The Treasury clarified, as the commissioner just mentioned, that whether income tax changes that simply conform a state's tax law with recent changes in federal income tax, regardless of the method of conformity and the effect on the tax revenue, the Treasury allows those conformity revenue losses as permissible use of ARPA funds, which is what the commissioner was saying. I think I might have made it more convoluted by reading from that, but I can share that with the committee.
Okay, that's good news. So Graham, I mean, the EITC, if we did that one, it's about 6.2 million. The child credit is about 1.5 million, and the PPP is 9.8 million, all in FY22. Is that
That's
correct?
right. But they have different impacts. So the first two, the EITC and the child dependent care, were not built into the forecast. And
right.
so,
No, I understand that. I understand that. And the third one is the PPP is built in, but still, they still are, costing the state revenue, whether they're built into our forecast or not. They're costing the state about $17 to $18 million in lost revenue. So can we fill in that lost revenue with ARPA funds, and have we done that in the budget assumption?
So
in the general fund assumptions?
Yeah, it's a good question. So my understanding from talking to Steve Klein was that the budget was built upon the revenue forecast of available revenue, and that revenue forecast includes, a downward, thing for PPP of about 9.7 million, and they've left on the bottom line, I think it was around $28 million to cover sort of any sort of leftover things. And Steve told me that the EITC for this 1 year and for the child dependent care credit, they have money to account for that. It is a kind of a weird sort of mental exercise to sort of say for the PPP that we would have $10 million more if we made it taxable, but because we have to conform, we could use ARPA money because it is technically built in our forecast, and technically the budget is built upon it. It's just kind of a weird.
I get that. I understand the forecast or not in the forecast, but the fact remains, it's still $18-ish million that would have been general fund dollars had we not conformed to and is there a line in the budget somewhere that says budget $18 million of ARPA in order to make up for the lost revenue?
I don't believe there is. No,
don't think so. Okay.
Where that would probably show up, and Graham can connect me, is when they do the next revenue forecast, there will be the ability to substitute in $18 million. We didn't lose it last year. We'll lose it next year. So when we do the revenue forecast in July, that's when the economists will say, oh, but you picked up $18 million. And so that's one-time money because it's basically a one-time loss. So you've got $18 million more in one-time money.
Right. Well, I'm hoping it sounds like they've already put the PPP into the revenue forecast, but did they do so by crediting ARPA to the general fund?
No, because that wasn't allowed.
But now that they should make sure, this is to Steve Klein, just to make sure that we credit this, if we're going to go ahead and do this, which I think we should do all three, but I also want to make sure we're getting credit for that revenue on the bottom line in the general fund.
Get that credit. And the way it works is to keep us all honest. There was a time when we had booming revenues and we put them into things like one-time kindergarten or full-time. And then the booming revenues went away. And it was the year before I came here, and the pain in the halls was palpable and part of the problem was different committees and the administration were saying, well, we don't think that revenue forecast is right. We're going to do our own. And part of the solution to those issues was we set up a system where the administration and the legislature's economists agree on a revenue forecast. And that's what the budget is built on. That gets done in January and July. When the emergency board meets in July, we will adopt the forecast for the second half of the year, and that's what you'll use in budget adjustment. And then they'll relook at it in July, but we can't go back and credit it to this year. It'll get credited to the next revenue forecast. It won't
Right,
come in.
I understand that. It's
Okay.
just that the PPP loans have already been included in the revenue forecast that we're working on right now for building the budget.
Yes.
But it just sounds like the ARPA part of it has not been included. So just making sure that somebody, whether it's Graham or whoever, is keeping track of that. And yeah, I understand it's one-time funds. It's not ongoing revenue, and that we have to be careful about that. So, yeah.
But that was because that was the federal link up at the time. So,
Yeah, I guess one more thing to chime in. I've asked Steve to come if he can, but it is, I don't think it's as straightforward just sort of saying, set aside $18 million for these 3 link up things and use ARPA money for it. You know, they in the budget have set aside a certain amount. We received, you know, I don't know how much it was total, but let's say it's $1 billion for ARPA in the coronavirus relief fund. They're setting aside some of that for next year, and then they've, you know, used ARPA money in certain programs and freed up general money elsewhere. And I don't know if there's sort of a line, and I don't think there is a line that says, you know, ARPA money to be used to decrease available or to offset available revenues. I think what they do is they just sort of, they have the starting point of the forecast, the available revenue, and then they build the budget based upon that, and then they use ARPA money to sort of cover various expenses that they can with ARPA.
okay. So committee, I'm going to do a straw poll. Okay, let's start with where I think it might go. Anyone who thinks that we probably should just exempt the PPP loans. Can I just get a show of hands?
Wait,
This is to make the PPP loans exempt.
okay.
And no,
No.
yes. Was that a question?
Madam Chair, I do have a question because my answer will depend on what we decide on other things. And so I'm happy to give you a straw poll and tell you yes, but I would reserve the right to change my mind if people are not as generous with other constituents.
Okay, well, I am assuming, since I've heard no dissenting voices, that EITC and the dependent care is going to go through, is tax exempt. If anyone disagrees with that, raise your hand. You don't want to tax exempt them, Senator Sarakian, you're muted.
I apologize again. I'm not raising my hand to say no. Maybe I'm slow on the uptake here. Do we have language on this? And just could someone tell me again, these 2 things, are they both 1-year things or are they ongoing tax credits?
I think what we learned today is both the EITC and the dependent care are 1 year. That doesn't mean the feds won't extend them. And the PPP grant loans end in May.
Okay.
So.
And so we have language, or we don't need it at this point?
No, we need it because we're linked up. We
I
excluded.
mean, we don't have
those.
it in front of us right now.
Right, no.
Okay.
And I don't know if Abby has done it because you don't usually draft something till we decide what it is.
That's correct, Madam Chair. I do have different options, but I'm just sort of waiting to see where you land. I could sort of explain different approaches, but I don't want to confuse the committee. I think it's easier if you think more about
More than we
outcomes,
are.
and then I'll draft based on what you decide.
Okay, so does anyone object to passing through the EITC and the dependent care credit? Okay, I didn't think so. So now, all those who think that we should make the PPP loans tax grants and the deductions tax exempt. Can we get a
Just-
show of hands?
Just question?
Question. Yeah, okay.
So we're doing a straw poll now. Are we going to have the night to think about the whole package and vote formally tomorrow? Or is this
Yes,
it?
no, well, yeah, I want to have Abby know what she needs to draft. I just want to know if this is worth going forward.
Okay.
Okay, so maybe who wants to tax them? That might be easier. Okay, so I think we've agreed they're not going to be taxable. So Abby can do that. And we've had Mark Peralt and did someone have a question for Steve?
Madam Chair, I asked Steve to come just in case there were questions about how we can handle ARPA money in the budget to cover some of the costs of these, or, the different options available.
Okay, so
Yeah, I was just
Steve,
going to say that Abby and Greg are right, that we'll just, the federal law does allow us to use ARPA money to cover bringing things in consistency with federal law. So originally we thought we'd use general fund, but I think that we'll put the language in the budget to make sure the money's there for it.
okay, so you replace the $8 million on the bottom line with ARPA money kind of thing?
I think probably we will. Yeah, I can't tell. It's up to the chairs.
So can I just follow up on that? So
Yeah.
Steve, I know that the PPP stuff is already in the revenue estimate. I get that, but that's a $9.8 million. We could also replace that with it. So it's
That's
more
what I'm
like
thinking.
17.5 million in ARPA that we could use.
That's what I'm thinking. I haven't talked this over with the money chairs and the appropriation chairs, but that's what all of that's eligible.
Yeah.
And they may choose to do that because that frees up general fund to do more of removing ARPA from other areas what the governor cares about. So I think that'll be something they work out, but yes, you're right.
Okay. I just want to make sure you were thinking along those lines. Thank you, Steve.
Yeah, but they obviously will have to make the decision.
Okay. I can talk to them if you want.
I think this is the big one. We have Mark Peralt here because Senator Pearson, you had questions about the property setting the yield. And so Mark is here and has been waiting patiently.
Some of us are hoping to be at a 5 o'clock meeting, Madam Chair.
Yes, some of us are. So let's.
Okay. Well, Mark, the House passed a slight decline in the yield, in the tax rate. And then we realized there were a bunch of expenses that are coming out of the ed fund. And so I guess I'm wondering if you can just refresh me on that and then tell me what would happen if we just kept the rate flat.
Okay, the big expenses are the pension related ones, right?
I believe the big ones are, then there's one or two others, potentially breakfast, blah, blah, blah. So
Breakfast is another year.
Right. Yeah. So some of those are out. The only thing that's coming into play this year that I'm aware of is the OPEB costs for teachers, which is a $13.8 million hit on the education fund in FY22, the year that's coming up. That's already passed, that's already part of the Senate passed budget. So that's reflected on the education fund outlook now. And if you were to maintain the same tax rates that the House has, which is a $0.015 reduction over FY21, you only have about $3.2 million left on the bottom line, surplus money.
And the
No.
House thought they had 13 on the bottom line.
So if we
Yes.
leave it where the current law is, not what the House
So
did.
if you leave the tax rates where they are right now, that left us with a $31.2 million surplus minus the 13.8 would give you $17.4 million. So you would have money if you did that, but that would require taking the rates up by $0.015.
Well, that's not true, Mark. That would
The
require
same rate.
leaving the rates where they are.
Correct. I'm talking, yes, you're right. That's right.
I don't believe the House Ways and Means Committee controls state law.
There you
Madam Chair, I'm reminded of my first experience on finance, which was 2 years ago, when we decided, no, we would rather have a little cushion, and we cut the House's proposal in half and send it back to them, and then they sent it back to us in a quarter. And we ended up leaving just a little bit of surplus, and it was better than nothing, and we all took it. And so I would like to propose that we leave it flat, that that puts us in a good position to negotiate. We are more than capable of adjusting it downward next year if needed, because there's a lot of moving parts in the ed fund. And this more than responsibly handles our pension thing. And I just think that rather than jerk it up and down, that there's wisdom in keeping it flat and understanding what these tumultuous years create for us. So that would be where I'd recommend we go. Maybe
Enough money on the bottom line now to cover breakfast if the feds stop funding that in the, not next year, but the year after.
Well, depends on whose version you use.
Committee, what's your thought on that? This is usually a dueling point. It's an annual event. It will most certainly assure we go to conference. But I think the PPP and all the rest of it will assure we go to conference. Senator Hardy.
So just to clarify, I want to make sure I understand what Senator Pearson's proposing. I'm looking at the preliminary ed fund outlook that Mark did for us. And are you suggesting that we go with the current 1.538 average homestead property tax rate? Is that what you're suggesting?
I think so, because I'm suggesting we make zero change.
Okay.
Not zero change to the House proposal, zero change to the law.
Correct. Okay. So it'd be the same for the current. And what would happen, Mark, with the non-homestead rate?
The non-homestead rate would be maintained at 1.628.
1.628. So is your intention, Senator Pearson, to keep them both?
They all float together.
Yep. Okay. I support that idea.
Senator McDonald.
Madam Chair, the revenues on that have been on a roller coaster. I think it would be just good policy to keep it flat and not try and dance with something that won't stand still. Keep it flat next year. Maybe we can keep it flat again, and we would have a record of some stable tax rate, and I think that's a wise idea.
I'm thinking of the discussion on radon. And what happens if radon comes in, and maybe HVAC takes care of it in a lot of places, but probably not all.
If I could jump in, Madam Chair, right now radon will be an unfunded mandate. And the only part of it that's an unfunded mandate is the testing, and testing is actually not very expensive. It's the remediation that might follow on the heels.
Yeah, no, I've done enough testing.
Okay.
But in areas smaller, you'd have to do several sets of tests. So I think they figured about 1,000, and it's about 300, I think, to do a house. So,
Madam Chair,
yes.
I don't want to hear what I'm not hearing. I would argue that the radon situation suggests a reason to have a little cushion, but maybe
yes, that's what I am suggesting.
Oh, okay, thank you.
I am suggesting that And I'm not sure who's paying to replace the Burlington High School. That gets us back. If they just replace it and put it on their tax rate, we're all going to pay for it. So I'm more comfortable with a little cushion given the volatility of real estate prices, because what goes up will come down. And they're due to come down. I'm just trying to get my house sold before they do. And it's not mine that I'm living in, the one I inherited. So anyway, is the committee happy with that? Anybody that doesn't want to do it, understanding that it'll probably get whittled down somewhat, but it'll leave us some cushion. Our reserves are full, right? This is just over and above the reserves. That's what I thought.
That's right, Madam Chair. And can I make just one other point? It's a small one, but I just don't want you to be surprised. The House has two other bills that they passed that draw money from the sales tax. It's the machinery and equipment exemption in H437
Yes.
and the menstrual products exemption in S53. So
Yes.
those would bring it down by another 1.6. So it doesn't. Build
Okay, well, I think we're going back with the menstrual products, and that's in the revenue bill, but I think that'll probably go.
Okay.
Okay, so committee, Abby, do you know what we need you to draft?
So Madam Chair, I do have language that I can share with you. I have one additional small technical change I was hoping to slot into this bill that relates to the link up. It has to do with the estate tax link up, which also is typically done. It doesn't have any impact. It's purely a drafting fix. There was a weird clause that could be interpreted as implying that the General Assembly has any authority over a federal code, which obviously it doesn't. So it's just hoping to strike a clause and add a new sentence just to clarify. It was something that went into H.
All right, we're not, federal income tax law is still federal income tax law.
Yes.
Okay. Not income, estate. And
tax,
we,
yes.
how late, we used to be like directly linked. The feds put in a rate and we got to take a percentage of that rate. And then they played with it and it got a lot more complicated. And I don't know where we are now.
I would need to review. I know that some of the definitions are pulled in. This is the one definition when the estate tax chapter refers to the laws of the United States. That's what the typical link up for estate tax does. However, there are many definitions and rates and things that Vermont does not follow. I would need to do a thorough review, though I haven't looked at that in much detail.
This wouldn't affect that.
This does not affect that. This is purely drafting. So if you'd like, I can share this language. I just want to flag what is in it. I'm going to email it. Is Faith still there? If she could share it with everyone.
Yes, she is.
I'm here. I'll share it.
Here we are. Thank you, Faith. The only language that I have left highlighted and empty for now is on the TIFs. So did not want to put anything in there for now based on your presentation today. Not sure if you want that placeholder in this bill.
I think at this point, just switching out those audits might be the easiest thing to do. I know it is a long time to go without an audit, but we've switched auditors, I believe, in that time frame, and I don't know. Okay.
Can I make a suggestion on that one? I don't know if it's worthwhile. It seems like the two parties really never talked to each other. I think the auditor said he's hearing about it, and the Burlington people were surprised. Could we suggest that they try and come back with a compromise?
Well, we've got to have a placeholder. It's got to be in one of the bills in order to deal with it in conference. So if we stick something in and then tell them, you guys work it out, we'll fix it, but we've got to have a placeholder in there.
Could we charge them to do it by 1 o'clock tomorrow or something?
We don't have to. If we put something in the bill, then they can come in next week while we're in conference and we can change the numbers. We can delete it, but it's not in the House bill, so it can go. It just has to have a placeholder, so it will be germane when we go to the floor with a final bill. So I think it's what the auditor asked for, which is that the downtown audit be kicked out to 2025, and that this year's audit be of the waterfront district.
Correct. And I think that's what we should put in.
Yeah.
And then we can
And
argue.
yeah. If they want to change that, they can come up with, nobody likes to be audited, and it takes time and it takes money, and but there is a fiduciary responsibility to the taxpayers to take a look at tens of millions of dollars, if not hundreds of millions of dollars that are going out the door. So, all right. So, Abby,
So
you got
I've just
language?
emailed the language. Hopefully you will see it shortly in your inboxes. Faith has it as
All right,
well.
so
We
it's
posted. Great.
Okay, it has shown up.
Wait, Abby,
Excellent.
I just want to make sure there were those two provisions from my amendments that I don't see those in here, or did I miss them?
Those have not been added yet.
Okay, but they're on your
So I
radar.
wasn't, so I was waiting to see which provisions the committee had approved. I'm afraid I didn't
Okay.
hear
There was
but I
just
can
the one about asking the tax department to report back on a plan for help or recommendations for helping municipalities with complex. So that I think it's section
Yes,
16.
mhm.
And then the other one is asking them to report back on the second home valuation categories, just those two provisions.
Okay, and the committee is ready for me to add those in. I can add those in as we're discussing.
Tax
Okay,
department pretty much said they're already working on them.
Great, thank you, everyone.
Okay, thank you. Okay. So what is in draft 1.2 that you just received, I can walk you through the sections, and I will add those further to reports. There are only 2 instances of amendment. This is not a strike all. So what it does, I hope that's okay. I could also redraft that
Oh,
as a
that's
strike all.
fine.
Okay. The first is striking out the sales and use tax statutory purpose section, so that both the purpose for the sales of recyclable paper carryout bags is in, as well as the hygiene products statutory purpose. So those are now both being added in section 11. There's a new section 11A, and this is the feminine hygiene products definition. So this is what would make these products exempt from sales tax. So that is what the Senate voted out in S53. The second instance of amendment strikes out. Oh,
Excuse me for interrupting, but the House also voted it. I just want to make sure we might as well go with their language if they made any change, or
they did not.
Okay, terrific. Thank you. Sorry.
It's the tax. Okay.
They left these 2 provisions untouched. The second instance of amendment strikes out the effective dates and then adds, this is where all of the new provisions are coming in. So the next few sections are all relating to the yields and non-homestead rate, and everything that was in H152 as passed from the House. And that's what I mentioned earlier. I've now put that language in. It excludes capital construction costs from the, so let's see, spending on eligible school capital project costs for a project that received preliminary approval. I believe you heard from both Becky Wasserman and Agency of Education on this. So that language is in there, as well as the merger districts, the declining enrollment and hold harmless provision, and the small school grants. So that's all of the language that was in H152 has passed the House. I've taken it wholesale, nothing has been touched. It's now being amended onto this bill. The next three sections are.
But you adjusted the rates.
Oh, so that is, I'm sorry, I skipped right over that. So the rates I've left highlighted, I will need to work with Mark to make sure I have the right rates for that. But as I will also be adding in Senator Hardy's two report proposals, I'll send you an updated draft.
And, yeah, thanks. And the auditor thing.
Adoption of federal income. Okay, we're adopting the laws that not the link update.
So this is where we got into what I didn't want to confuse your discussion earlier, how we actually get to your goal of following the federal treatment of PPP loans. So what is happening in the section 21 on page 6 of draft 1.2, it adopts federal income tax code in effect as of March 31st this year. So it also in the effective dates is applying it only to tax year 21 going forward. What this means is that you.
Does this mean we're linking in advance of the House? It's very important that they're linking to next year's code, not that we're not linking retroactively. That was the most important thing to them. Does putting that March 31st date in there change us to linking to last year? Or are we still linking prospectively?
It's technically retroactive because March 31st has already passed, but it is just for tax year 21 and going forward. So so what this means is that the EITC changes and the child independent care credit changes, those would all be pulled in and applied to tax year 21. Currently, those are only for 1 year. So that's all that's being pulled in with this language is the tax year 21 treatment for those two credits and other ARPA provisions.
Okay.
So that's what's happening in section 21. Section 22 is the estate tax link up that I was just mentioning, where it just strikes out the language and moves it down out of that clause to make it clear. The intention behind including any of that language was to make it clear that with all of these retroactive and sort of last minute federal changes, that the tax department wouldn't make any assumptions about its forms, just because Vermont has typically been sort of a rolling conformity state. This was just a clear statement
that makes it very clear that don't print your forms and then tell us you can't make changes because your forms are printed. All right. That may make them happy.
And again, this change is really just to clarify the drafting. It doesn't change any dates. On the very start of page 7 on line 1, this was where it popped up at one point when you were discussing what to do for PPP loans. This repeals the add back, the way that Act 9 H3 15 made forgiven PPP loans included in taxable income. This repeals that provision. So it repeals session.
So that's how the House did. They added it back. We're now taking it out. All right.
And I've left highlighted and empty for the time being the TIF changes. But if you would like me to go forward with the
just check with the auditor's office, but I think we're going to say they can switch out the districts to be audited this year or next year, whenever find a date in the near future, and kick the other one out to 2005 or later. Okay. Or 2025. Okay, it's after 5 and I'm getting very tired. So let's move this along.
So all of the effective dates up until, so the first 3 subdivisions that you see there were what were in the underlying bill as passed out of the House. The additional subdivisions have the H-152 property tax changes taking effect on passage. And then you get into these, you do need to have retroactive effective dates for the annual link up, just because the federal code, it's linking up to a prior point in time. So the way that the ARPA changes will be pulled in is it takes effect March 31st, 2021, and it applies to taxable years beginning on and after 2021. There's also the federal estate tax link up. It supersedes what was enacted in H315, and identically in the very last subdivision 7, it takes effect at the same time as when Act 9 H315 made the forgiven PPP loans part of taxable income. So this just supersedes that. On that.
Okay, committee, are we ready to go home or to another meeting? We'll take a look at this tomorrow and vote it out one way or the other. So I think that's it for today. Faith, we can go off live.
Ending live.